information that session is recorded so students can access to the materials at a later stage. So an important topic, ESG and investments and fund management. As you know, we are in a situation where the economy and the economics theory is at the road. Everything is being redefined, and COVID has made that even more structural, even a faster rate of change and a deeper mutation. One of the key attributes that finance research from an academic point of view, we used to have a correlation between ESG and financial performance. Now it looks like that academic researchers in finance, they found that there is a causal factor between environmental, social, and governance factors and financial performance. It looks like now companies that do care more about the environment, about the social factor, about the governance, and which are more ethical, tend to perform better than the other one. So one of the largest fund management in the world, they have decided to reach $1 trillion in terms of investment in ESG in the next decade, up from 90 billion at the moment. It was also demonstrated that in the past 10 years, all the funds and ESG companies have outperformed the market or the benchmarks. There is a new economic theory at the moment which talks about the general interest. Who's going to take care of the general interest? The general interest used to be the responsibility of public administrations, but it looks like public administrations will not have the financial means and the technological knowledge to take care of the public interest. It looks like global corporations at some point will have a social and global responsibility. And therefore, we need to have in place an ESG standards. A sustainable profit is also a profit that is probably capped in the short term and perpetual if possible. So the greatest enemy of capitalism is greed. So the best solution for a profit sustainability is to have sustainable profit, and a profit that are limited in time and are measured. However, they are there for the long term. So a lot of companies and a lot of global companies, they care about measured and ethical profit. This is what will keep those profits and the system in general more sustainable in the long term. So I've tried to introduce the topic, and it's a fascinating topic, especially in regions where our mission statement is to educate tomorrow global leaders. And sustainability and ethics and doing things right and well is one of the key attributes that we try to teach here at Regent. That's why this topic is important. And I'm sure that you will have a lot of questions that our panelists will answer. So before I'll hand up the floor to our guest, I would like to welcome Dr. Jacob Schmidt, a senior lecturer in finance and banking at Regent University and a co-director of our Center of Banking and Finance, alongside Mr. Robin Dickinson, a senior lecturer at Regent University in sustainability and energy economics. Our thanks and deep and warm welcome are for Charlie McCann from NLPFM Fund Management, who will be talking about an overview on the ESG screening methodologies for funds. So Charlie is an investment analyst at NLP Financial Management investment team, specializing in sustainability and ESG. Having reached ESG funds for almost 3 years, he's in charge of NLPFM Sustainable Portfolio. He has a degree in econometrics and quantitative economics from University of East Anglia. He has the investment management certificate from CFA Institute from June 2016, and he has passed the CFA level 1. Last but not least, I'm extremely privileged to welcome our final speaker, Ms. Abbie Llewellyn-Waters, who is a fund manager and environment and sustainability at Jupiter Global Sustainable Equities. So that's, I think this is any other Jacob. I think it was corrected. It was supposed to be corrected. So it's not.
That's great, yeah.
Yeah. It's great. Yeah, it's great. Thank you.
Corrected, yes?
Yes.
Okay, thank you. So Abbie joined Jupiter in 2006 and is a global equity portfolio manager in the Global Sustainable Equity team. She manages the Jupiter Global Sustainable Equities funds and has been a lead portfolio manager of institutional funds since 2012. Previously, she was a co-manager of the multi-asset Jupiter Global Ecology Diversified Fund. Abbie has been awarded Impact Manager of the Year in 2019. LA PF Awards. Also in 2017, Abbie was awarded both Fund Manager of the Year and Investment Woman of the Year at Investment Week inaugural Women in Investment Awards. Abbie is also contributing member of several industries initiatives. For example, she is an ambassador of the Diversity Project and a member of the 30% Club UK Investor Group. She has a degree in classics from University College London. It's extreme, as I said, privilege to welcome Abbie among us, and I'm sure students will have a lot of questions for you. So we will start with the first presentation with Dr. Schmidt, who will be talking about his final recent paper, which is Standard of Sustainable Investing, which offer the better performance for the passive investor. Jacob, over to you.
I think, thank you very much, Elias. Thank you for the introduction. I think we decided that Robin perhaps goes first, as he's our sustainability lead within the university, and he can kind of kick off, and then I talk about my paper, and then we continue with Charlie and with Abbie, and then we have the panel. So over to Robin, please.
Robin.
Hello, welcome. Well, thank you for the introduction as well. I've got 10 minutes really to try and sort of cover some ground, and I thought I'd try and introduce and provide some background on the topic. I'll probably just give you a quick sort of background on my credentials, and then I'll probably go to the second topic, which is driven by financial regulators are looking to promote how the governance of ESG is happening in the investment community. And I've been receiving some sort of requests for micro briefings from pension trustees about why has that happened? What are the fundamentals that are underlining that? And I thought I might share a little bit of that briefly with you guys as well, to position why it's suddenly of the moment a topical issue. And then finally, the headline was Fractal Sustainability, which goes to the core of this conference, which is around ESG investing and addresses a particular issue around, and something we'll probably touch on, greenwashing. So those are the three areas I'm going to try and cover in the next 10 minutes. So hopefully it will be quite illuminating. Just to give you quickly from my background, in terms of my credentials, I've been working in the field of tactical metrics for about 20 years now in the area of sustainability for businesses. I started with climate change right back at the change of the millennium, and for 10 years I've been working on the development of guidance on how companies and businesses can measure their impact over supply chains. We call that life cycle analysis, scope 3. And in the late noughties I was tasked with the Carbon Trust. I was at Carbon Trust at the time, is to try and create international alignment of these standards, so there's some sort of mutual confidence that whatever you're measuring, whether it's CDP or GRI or whatever, however you're measuring your carbon impact, it materially is very similar or the same. And in the last decade, really, I've been working on a new area, which was around biodiversity, which is developed into natural capital and how businesses can tactically measure their impacts in that way. And I was very pleased that just 2 weeks ago, actually, 2 months ago, 8 weeks ago to the day, the biodiversity guidance for the Natural Capital Protocol, which is a tactical guidance and metrics on how businesses can assess their biodiversity impact, was published. So that's my background. In terms of the second question, which is why has the regulators started to focus on this and guide investments and investees and the whole investment community to focus on ESG credentials, I thought I'd sort of share a quick briefing, and I'm going to share some slides, if that's okay, with you. What's happened here? Hopefully this is it. Oh, no, it's not. Forgive me. I think I've got a problem here. Oh, can you see that? No, you can't. Well, I was going to share a slide set with you. It worked earlier on. My slide set seems to have disappeared, so I will try again one more time. We're used to these technical issues. Can you see my screen?
Not yet.
No, you can't. Okay. Well, in that case, I'm going to have to kind of wing it, I suppose. I mean, do you want me to carry on, or do you want someone else to?
Robin, you can put the slide. You can put your file in the chat box. I'll try to share your screen, my screen.
Okay.
Yeah, and I will check the slides for you.
Okay. I'm afraid this is Teams is defeating me at the moment.
Or you can email them to me as you wish.
Okay. Oh, this is terrible. I do apologise for this. It worked half an hour ago. It was working fine. Jacob, can I suggest that maybe you carry on and I try and get the presentation sent to Elias.
Absolutely. Thank you very much, Robin. Thank you for the introduction and for establishing the theme here. I'm trying to open my presentation. I might have a similar issue, but as we know from my experience of the last 30 years, that the technology is great. It doesn't always work, and it reminds me of a PhD presentation I had to give a few years ago when I finished my PhD. And I went to a seminar and I wanted to give my presentation, and nothing worked. So very similar to that. We might be in a situation here where we might not necessarily be able to share what we want to share. But what I wanted to present here was, obviously, my interest in ESG is both an academic one and a practical one. As Elias explained at the beginning, I've been with Regent University now for almost 20 years, exactly 18 years. I joined in 2002. and I'm still very young. Actually, I'm celebrating my 26th birthday today. It's not a joke, because I've come to this country 26 years ago, and I started my career at Citibank at a tender age of whatever it was, and now I've been in this country for 26 years, and I'm very proud and privileged to be here, and very proud to be with Regent University, where I teach finance and research, financial markets, and financial markets, wealth management, and other finance-related issues. But I also have a practical interest in ESG with my other hat on at NLPFM, where I'm the chief investment analyst, and where, as Charlie will explain later, we are quite involved in ESG, and we've been researching and investing into ESG for many years. So I would like to present to you, and at this paper, unfortunately, it doesn't seem to be working. So even though I tried to share the content, we have a sharing issue here, but it doesn't matter. I'm going to tell you in words what otherwise you would see on slides. And I said this was the case a few years ago at the PhD presentation, and sometimes when you're pitching with clients, you might have similar issues. So I, together with another author, actually a former student of mine, Daniel Kajnouri, we wrote a paper about ESG performance, and we're looking at ESG. As said, the interest was that would we be able to look at the performance, and what's the performance of ESG versus non-ESG. And as we said, ESG has become a major investment idea. Obviously, it has evolved over the last 20 years from social responsible investment and so forth. And so we are familiar with that. So we looked into the performance of that, and we said, how could we do that? And the idea was that we should look at it firstly from an index point of view and say which kind of indices are out there, and then say how would these indices have performed being ESG indices versus non-ESG indices. And as you know, the topic of the paper, which we put up also on the invitation here for this one, is like a standard, a sustainable, which gives you the better performance from a passive point of view. So we can have later discussion about that, or whether you should really invest into passive rather than active, and that is a discussion on its own, and I don't want to cover that in my presentation. In my presentation, really what I want to talk about is that what did we do, and what was our conclusion. So we looked at the four indices: MSCI, US, World, Europe, and Asia, and compared them with the MSCI ESG screened indices. Okay, so what are these MSCI screened indices? These are indices that cover all the companies that are screened by MSCI according to their methodology and are so-called negative screens. And Charlie and Abbie will cover that in more detail later, but it's basically excluding tobacco, weapons, and other dangerous areas that you don't want to be exposed to. Obviously, there's another approach that is the positive, not the negative screening, but the positive screening, looking at companies that are actually doing something good, that are actively, they're changing, they're coming better, and so on. And there are indices that do that. Okay, one being the ESG Leaders Index and so on. But we decided to do the ESG screen indices because they are established, they cover lots of companies and so on. They have no bias or less of a bias. And whenever you look at indices, you have always this issue of is there bias in the index construction? and so on. So we compared the 4 non-ESG with the 4 ESG screen indices, and over a period of 8 years, from 2013 to 2020, daily performance of these indices. So daily performance of the indices, and compare that and say, what is the alpha? And you know what the alpha is? The alpha is the outperformance over a benchmark. Okay, so alpha you can define as what do I get by getting into, for example, into an actively managed fund? What is the fund manager producing? Here we define alpha as what is this ESG? What does the ESG do to me versus non-ESG? And we compared, we calculated the alpha, and we calculated so-called Sharpe ratios. You know what a Sharpe ratio is? The Sharpe ratio is basically a risk-adjusted relative measure of the performance of a fund. So basically saying I have the performance over risk-free rate over the volatility. So it's a volatility-adjusted measure. We usually say that the Sharpe ratio of more than 1 is a good Sharpe ratio. Is every performance increase in performance is better than the volatility I'm getting. So if I have a Sharpe ratio of 1, that means that actually my additional performance costs me the same level of risk. For 1 level of performance plus performance, additional performance means a 1% higher volatility. If I have a Sharpe ratio of 1.5, then obviously I have more performance that I'm getting in volatility. So we looked at the alphas, and we looked at the Sharpe ratios, and we found that over this period of 8 years, that actually in most cases, in most years, there is a positive alpha. That's the good news. Okay, not in all years, not in all regions. Okay, but in most years, actually, there's a positive alpha, and that is actually a very nice result, because when you look at something at the beginning, obviously, if you look at the research project, you have to be careful that you're not re-engineering something. You know it is an alpha, and because of the alpha, I'm trying to prove that. So we said we didn't know that. Okay, so we said, yeah, there's an alpha, and unfortunately, you don't see now the table, but you find it in our paper if you're interested in downloading it. But I can tell you here that for the US, the total alpha over this period of 7 years is 5.6%. So by being invested in ESG over a period of 7 years in the US, you would have gotten an alpha of 5.6%. For the entire world, the alpha would have been 4.1%, for emerging markets, 2.4%, and for Europe, 0.57%. So the alpha in Europe over this period, over our period, was only 0.57%. Then we also looked at it, and we constructed a portfolio, equally weighted portfolio of these 4 regions, and said what would have the alpha been of an equally weighted portfolio, and the alpha would have been 2.56% over 7 years. Okay, so it's a nice alpha. However, the alpha seems to be mainly in the US and less in Europe. That's another discussion that we can then have, why this is the case. The second one, we looked at the Sharpe ratios, and what are these Sharpe ratios and so on. We calculated yearly Sharpe ratios, so yearly performance of a yearly volatility, and we found that actually the Sharpe ratios, both for the non-screen as well as the screen, in 2019 were very good. Sharpe ratios were around 2.4 for the US, and for ESG similar, and so on. The year before negative, and so on, because obviously it's heavily influenced by the performance of the year 2018, as if you remember, was a difficult year for the market. So we had very nice Sharpe ratios, but more importantly, we also tested the Sharpe ratios for significance. So we calculated significance. We found that the Sharpe ratios, both for the traditional, but in particular for the ESG screen funds, actually have Sharpe ratios that are significant at the 95%, and in some cases even at the 99% a confidence interval. So from a statistical, from an economic point of view, very positive. So in conclusion, we found that actually our hypothesis of whether these sustainable investments have a better performance can be positively answered. Yes, they do that. There's a trend, okay? There's a better alpha in better Sharpe ratios in the US than in Europe. That is another issue that we can discuss. And we believe that this trend of investors will continue. What I haven't mentioned before is, which Charlie and Abbie will answer, is that there has been an enormous increase in asset inflows in ESG funds and so on. But our research really focuses on the indices and not so much on the funds. But that is then the next step probably of our research. We'll look at other indices with the actively managed solutions and so on. But the research here shows that ESG does produce positive alpha, which is good news, and has very nice, significant Sharpe ratios. And with this, I pass on to Charlie, who is going to talk about now ESG investments from a practical point of view.
Jacob, before we jump to Charlie, let's try to share. Thank you for this. Let's try to share the screen once more for Robin, and then we move to the professionals.
Yeah, Robin, if you want.
A very good conclusion. It looks like from the introduction that building a portfolio by adding ESG stocks, you will outperform the market in terms of market risk and in terms of volatility specific risk. That's an excellent starting point. And let me try. Technology is like bankers. When you need it, it doesn't work. That's
exactly.
Let me try to share this screen, my screen with you. Can you see Robin's slides?
I can. Can we go? Yeah, brilliant.
Robin, the floor is yours.
Go to full screen, Elias?
Sure, I can.
To presentation, so it build the slide. So if you present it, you should be able to see it like that.
I think I've spoken too early. It did work.
There we go. Brilliant. Okay, so thank you, and thank you. I do apologise, but at least you can see the screen. So let's begin. My first sort of premise was around why have the regulators started to proactively seek some governance around ESG funds and the investment industry, and this is a sort of response to the question of what's changed really. And fundamentally, the position is this picture, which is our beautiful planet, which is a really unremarkable piece of rock, like many billions others in the universe. But it has a unique characteristic. And as you can see, in planetary terms, it is in essence coated with a living form. Life form coats this rock, which is the Earth. And that is truly unique within the universe. And that's really the starting position. It is finite. It's a beautiful thing. It has this living coat surrounding it. So if we go on to the next point, within that living coat, one key element or contributor to the life that surrounds this rock is us. It's humanity. And as you can see on the right there, and we're familiar in terms of our COVID experience, I think, of these exponential curves. You can see that the quantity of humanity is actually in an exponential ascent. And this fundamentally is what's driving the situation. So if you go to the next, if we look at the period between, if you look at the period between the turn of the century, 1999, and now, the last 20 years, the population of the planet, of humanity on the planet, has grown by 1,800 million souls, and which is the equivalent of the entire population of China and the USA has been added to our planet, to our body, humanity, and that's an increase of 30%. So the population has increased by 30% in 20 years, and that's a fairly significant figure. And as you can see, the rate is upwards, and that number as well is coinciding with actually hitting some limits. So the picture you can see on the right is a study that was carried out called the Planetary Boundaries Work, and it highlights that the living ecosystem around the planet is actually straining now under human influence in terms of the aspirations of this body of humanity, as well as the sheer numbers. And because of that, if you go on to the next, we have this interrelationship in human society where, you know, society is dependent upon the environment, and business and the economy is dependent upon society. So if the environment becomes unstable, if that's the next point, we get instability, which works its way up. Clearly, if the environment is unstable, it leads to instability in society and instability in the economy, and that leads to risk. And in essence, that is the fundamental that has changed over the last 20 years. That means that the regulators are now being proactive in seeking greater governance in the investment community around ESG. So I thought that was a sort of a very rapid sort of expose, but that's really when say trustees have asked me, that's kind of my response to that question. And that is a slightly separate question to the one that Jacob has been, his research is highlighted, and the focus of this conference, which is around actually funds and ESG funds and how they are performing and the consequence of that. And this derives from a slightly separate set of theory. So on the left-hand side, we have, in essence, something called the triple bottom line, or a pictorial representation of that, which is this sort of idea that sustainability, which is in the center, is actually a balance between financial net gain or profit in a period, and that should be balanced with the net gain or net interaction with society and people by a business, or it should be balanced by its interaction with the environment in a particular period. This was developed by Elkington some 25 years ago, and this is really the concept of sustainability in a business context being a balance between these forces. And really, over the last since that time, it's sort of translated into the concept of a time series. So it's not just in any one particular period, it's about how it develops over time. So sustainability, going back to the original sort of financial context of sustained earnings, is really a consequence of businesses that engage in this sort of balanced approach over time, and businesses that do engage in sustainability over time, build innovation, more efficient, greater governance, collaboration. All of these things contribute, in theory, to more sustained earnings, which is in essence the basis of performance, as highlighted by Jacob in his earlier paper. So the challenge really is that with the financial regulations coming in, with this sort of premise, a huge amount of focus and in some ways greenwash is occurring. And the challenge is really, how do you separate those businesses that were engaged in this a true sustainable way from those who are pretending, in essence, by using the words, but aren't really substantially delivering on the promise of a sustainable culture and perspective, and therefore delivering a sustainable performance. And this was a problem that I focused on with my colleague, Dr. Cantor-Deloro, some time ago, and we worked around the principle of fractals. And the idea was to try and identify that this image is a fractal. There's a central premise which we articulated as being sustainable understanding. And the idea was to try and assess to what extent the understanding of sustainability was imbued throughout an organization at different levels. So the idea was that with a fractal, you can explore the same problem at different levels within the organization. And this is really what this sort of brain-like representation was meant to articulate. And based on this theory, the idea was understanding how well sustainable principles were understood within the organization and its stakeholders. If you go on to the next stage, the last slide. I don't know if can we go on to the last one, Elias? Or there we go. So what we developed is a metric, based on my background, we developed a metric whereby you could assess how well the understanding of sustainability principles were. You could then use that as part of a learning environment, the LMS system, to help develop the understanding within the business. And lastly, the last element was that you could come up with a score. So if we touch the last one, Elias, the last, is there one more? No. Oh, okay. No. Oh, there you go. So you could actually come up with a number that reflects the extent to which the sustainability principles are available within that organization. So you could compare one with another. So that is very briefly is what fractal sustainability was about. And hopefully I've addressed the three objectives I had at the beginning, which was why finance and why fractal sustainability is pertinent to ESG.
Thank you very much, Robin. I think I managed to follow you slightly. Apologies if I was delayed.
No, very good. Thank you. Appreciate it.
Thank you very much. I will definitely have a question or two for you and for Jakob at the end. Now, if we can move quickly to Charlie. Charlie, I'll stop sharing. Can you try to share your screen? If not, I will do the same.
Thank you, Elias. I'll certainly give it a go, see if I can fare a little bit better than some of the predecessors. Can anyone see these slides now?
Yes, indeed.
Okay, brilliant. Well, thank you, Elias, for the introduction earlier. As you mentioned, I'm an investment analyst at NLP Financial Management and Birchwood Investment Management as part of the NLPFM group. I've been working there for close to 6 years now, and for about 3 to 3.5 of those 6 years, we've really started to focus significantly more on ESG and sustainable investing. So over the next few slides, I'd just like to discuss the growth of the space that, as Jacob's already alluded to, for discretionary fund managers, and both the opportunities but also challenges that does present for a discretionary manager, before taking a little bit of a deeper dive into how we look at sustainable investing NLP. So I'll start with this slide here. As mentioned previously, there has been a huge shift towards moving in a more sustainable society in recent years. We've seen in sort of the last 10 years the issues that have really started to become more prominent within society and the environment has really taken the notice of key policy makers. We saw in 2015 the UN introduced the framework for Convention on Climate Change, otherwise known as the Paris Agreement, where they target keeping the rise in temperature to below 2 degrees Celsius for this century. In the same year, there was also the introduction of the UN Sustainable Development Goals, which aims to both limit the damage that we are doing, but also find solutions to the damaging effects that we've already had as a way of living in this society. And it also provides an interesting framework for governments, corporates, and also the investment world to act upon. As you can see from these two charts here, starting on the left-hand side, we've seen a huge surge in the level of sustainable investment funds. This is taken from the Morningstar ESG fund assets report from Q3 at the end of Q3, where it shows that sustainable investing assets on funds themselves actually surpassed the 1.2 trillion mark for the first time since they became such a big theme, and the level of flows into these funds was up 19% from the previous quarter. On the right-hand side, we can see the level of fund launches in the space over the last 3 years or so. As you can see, it's really started to pick up momentum over the last year or two. And the last quarter was a record breaker. We actually saw 166 new fund launches, bringing the total number of sustainable funds on a global level up to over 3,700. What's been so interesting about sustainable funds this year in particular is that these inflows have remained strong, even during some of the toughest periods for markets where we actually saw assets flowing out. So if I use the first quarter of this year as an example, sustainable funds globally saw about $45 billion in inflows, and this was during a time where traditional funds actually saw outflows of about $384 billion. And this is a trend that we've been able to continue throughout the rest of this year, and I believe longer term that trend will continue even further. So this is positive news, of course, but I think there is a need to remain cautious. ESG funds are expected to reach over 7.6 trillion euros over the next 5 years, and that's according to a recent report from PwC, and that would actually represent over 50% of the total level of assets in funds in Europe. Whilst this is a positive in terms of the fact that assets are flowing in that direction, you do need to be aware that this could expose investors to greenwashing, which Robin also alluded to earlier. Last year, taking last year as an example, there were nearly 500 funds that added ESG criteria to their prospectuses. But they are not necessarily ESG funds. They are more funds that just take ESG into their consideration of the overall risk of a particular company or stock or bond. And in reality, there's been little change to those overall investment processes. So I think it does really shine a light on the fact that you do have to be very selective and have an extremely robust due diligence process. So ESG investing as a whole, it's a wide space. There are so many different variants, and they can vary wildly in terms of their approach. These are just a few of the sort of terms that you see quite often crop up. And it can lead to a little bit of confusion, especially for the less aware investors who are buying some of these funds, who will likely take a different view to those of the fund managers, and they're not quite understanding of what the actual approach is. We've seen a spike in funds, as I mentioned, which integrate ESG into their investment approach. That's not necessarily to mean that they are ESG or sustainable managers. It just means that they consider it as part of their risk management when looking at a company. Exclusions-based investing, which really goes back to sort of where this started about 20, 30 years ago as the more traditional ethical funds. Whilst it is good in terms of excluding some of the most harmful companies, it doesn't focus enough on the positive side of things. And really, as Jacob alluded to earlier, it does take out those negative companies, but doesn't really focus enough on those which are providing the most positive solutions to the challenges facing us as a society. Best in class as a theme is not without its problems as well, and I'll talk about that perhaps in a further slide. And impact investing, whilst being probably the most robust from an ESG or sustainable point of view, can sometimes veer, in certain instances, veer too far in the philanthropy way and further away from focusing on financial returns. So they all have their pros and cons. So Jacob mentioned looking at indices that screen out certain companies. There are also indices that focus predominantly on the leading ESG companies and that focus on those with a particular rating from a certain ratings agency. There are quite a few out there, and this does pose particular problems when you're looking at investing in ESG or sustainable from a passive point of view. Ørsted is a company on the left-hand side, which maybe some of you do or don't know. They're a Danish offshore wind producer, and they're actually the largest offshore wind company in the world now. And they transitioned fully from a natural gas and an oil company only about 15 years ago to being completely offshore wind. They were listed this year as the most sustainable company in the world in a 2020 Global 100 index. Yet one ratings agency gives them an ESG risk rating of about medium, which is in line with British American Tobacco, the third company along, obviously one of the world's largest producers of cigarette and tobacco products. Now, you know, even without taking too much of a deep dive, it doesn't seem to make sense that a tobacco company that's actively producing products that do harm to people is rated the same on an ESG point of view as a company that's trying to provide wind energy. Tesla's a very interesting company. You're probably all aware of the meteoric rise of the share price this year and the big personality CEO Elon Musk. But this is one that really just shows the stark difference if you look from one ratings agency to another. One of them views Tesla as being the best scoring company in the auto space from an ESG perspective, whereas another actually views it as being one of the worst. Diageo on the far right-hand side is one of the largest alcohol and spirits manufacturers in the world, and they're actually rated by one agency as a low risk to ESG, which doesn't make any sense at all. So I think what I'm really trying to say here is that it's really difficult to know what you're going to get when you're buying a passive ESG index. And it's important to have that level of due diligence and to go, I think, anyway, at least the active way. So what is sustainable investing? It does mean many different things to many different people, and because there's no industry standard, that doesn't necessarily mean that anyone is particularly wrong. The view that we take, NLP and Birchwood, when we're looking for sustainable investment opportunities, is companies that are providing solutions to the biggest challenges facing us today in society. We're looking for companies with innovation, the ability to disrupt the more traditional, more harmful industries, world leaders in their space, sustainability from a financial point of view as well. You know, we're looking for those companies with the resilience in their balance sheet and the ability to last through some of the biggest crises that we've seen. And that's something that we've been able to show this year, particularly during the first few months of the year when markets were very turbulent. We're looking for those companies that can benefit from some of the strongest secular tailwinds in terms of the themes and sectors. An example of this is, you know, working from home and the digitalization that we've seen this year. A lot of companies have been able to benefit from the technology that they offer, and healthcare is another as well. It's a particularly big part of our portfolio, and providing some of the vaccines or testings for the coronavirus for the future. And we're looking for companies underlying in those fund managers that are able to buy these companies with the strongest ESG ethos, so that's environment, society and governance. We're looking for those companies that really do show that resoluteness and look after their stakeholders as a whole, not just their shareholders, but also their employees and the people in the nearby society that they serve. So this is a bit of a shameless plug to end on here, really, but just in terms of the portfolio that we've been able to build over the last 2.5 years, NLP and Birchwood Investment Management, it's a highly diversified portfolio with a focus on those funds which can invest into some of the biggest winners in the sustainability world that we see. It's got over 2 years track record, as I mentioned, and it performed well in those first 1.5 years to 2 years. But I think what's happened this year has been possibly the most impressive and what we're most proud of across the business. Year to date, although this doesn't show in these figures, the portfolio is up over 8%. And this is during a time where the UK market, which we compare ourselves to, is down over 16%. And since the inception of the portfolio in the summer of 2018, the portfolio is up over 18%, whereas the UK market has fallen by 12%. And if you can see on a more granular basis, the month-by-month performance, February and March were particularly something we were proud of, as it was able to hold up really well in some of the most difficult market conditions that we've seen in recent years. And not only that, on the way back up in the recovery months, we've been able to keep up very well. And I think this goes on to what I was saying before about investing in companies that have that resilience in their balance sheets and that robustness in their approach, and finding the fund managers that have got the long-term track records and are able to deliver these attractive risk return opportunities. And just lastly, on the right hand side, we're looking for an asymmetry of returns. We aim to capture as much of the market upside as possible whilst limiting that downside exposure. And although it's only been 2.5 years so far, we have been able to do that, and it's something we're very happy with, and we hope that it does continue. So with that, I think that's pretty much it from me. So I shall pass on to Abbie.
Thank you very much, Charlie. Thanks a lot. Thanks to all the speakers for staying within the time. And last but not least, we go to Abbie. Abbie, the floor is yours. If you can try to share your screen, otherwise I would be very happy to change the slides for you.
Thank you. I think my colleague very kindly is going to take on that task for me. But in the meantime, I'll introduce myself. I've had a detailed introduction already, so I won't go into too much further detail. My name's Abbie Llewellyn-Waters, and I am the fund manager of the Jupiter Global Sustainable Equities Fund. Interestingly, I spent my first 10 years in sustainable investing running clean tech portfolios. And in 2017, I transitioned off those funds to launch the Global Sustainable Equities Fund, really to enable clients access to mainstream global equities on a diversified and liquid basis, whilst also aligning their savings to a sustainable agenda. And I'm going to focus my comments this evening on thinking about sustainable investing within the context of capital allocation and, by extension, fiduciary duty. And hopefully, we can offer some explanation as to why this form of investing is attracting so many of the flows that we've already heard about from the three previous speakers. Toby, I'm not sure if you're having much luck on those, but if somebody else is able to share.
Elias, are you okay to share those? It's not working my end.
Okay.
So what we're going to discuss within the slides when they come up is really thinking about the landscape, the challenges that are presented, and where we see the solution. And from a landscape perspective, the other speakers have alluded to it, coronavirus has shattered the status quo and has unveiled a fragility within our world economy. And I'm going to spend some time digging into what that looks like on a specific landscape perspective. The challenge, the way that we see it, we've heard some of the challenges, but for us, it's about redefining sustainable investing. You know, this isn't an ethical or values proposition. This is about enhancing client outcomes in terms of the planet, the people, and profit. And we're going to go into that in much more detail. And the solution really is looking at, as we see an expansion of fiduciary duty, and within this broadening, what we encourage clients and market participants to consider is this isn't a tick box exercise, but an opportunity to drive underlying member or underlying client understanding of how their capital is allocated and how their capital supports the transition to a more sustainable world. And as we go forward, give me a shout when those slides are working. I think it's worth sort of reflecting on the landscape. And if we allow ourselves to return to the very distant memory of the beginning of this year, when most of us on this call probably didn't know the definition of epidemiology, the World Economic Forum published its Global Risks Report for 2020. I've included a matrix in the slides if they get loaded, but the top 5 risks were all environmental. So highly likely, significant impact. So these are risks like extreme weather, policy inertia, biodiversity loss, which we've already heard about, natural disaster, human-made damage, so oil spills, pollution. They also did identify infectious diseases as a risk. Their conclusion was not very likely, but big impact. So I'll leave you to decide whether or not that was an accurate assessment. But we do know that viruses, like greenhouse gases, care little for borders. And when we think about these risks, this is not philosophical, consumer preference, populist, political, or ideological risks. These are economic risks that underpin fiduciary duty. And when we think about it through that lens, the conversation fast becomes about value rather than values. And as we go through to the next slide, if we can have them, but if we don't, we can't. One of the slides that we've got there, maybe they'll be distributed afterwards, is if we flip that coin and look at how the economy has fallen apart, the old tenets of socioeconomic stability have eroded to a certain degree. Energy demand has fallen the most in relative and absolute terms since the end of the Second World War. That is significant. We have the invisible hand of economic contraction withdrawing demand. If we couple that with the very visible hand of legislative intervention, earlier this year, the IEA set out the landscape of policy disruption. So a policy disruption landscape that is in effect mandating a reduction in demand for carbon intensive industries. And since they published their report, the IEA published their report in autumn, we know that Europe last month came out with a target to halve emissions in the next 9 years. China also committed to be carbon neutral by 2060. And the Biden-Harris administration is looking very likely to pursue aggressive decarbonisation in line with Europe's commitment, and also committing to the legal bindings of the Paris Agreement. So we've got this fast changing landscape on an environmental basis. And if we look at that from a demand perspective and look at it then through the supplier perspective, it is very clear that coal, oil, natural gas are the biggest losers. We heard about Ørsted from Charlie. That company used to be called the Danish Oil and Natural Gas Company. It used to be called Dong Energy. They identified a decade or so ago the direction of travel and repositioned their business. Coal, oil, natural gas have serious demand concerns over the next decade. And we know that this is legally mandated to happen. And coronavirus has been a catalyst for change, and perhaps we'll come on to that on the panel. The predictions that were made by the IEA in terms of demand contraction were quite aggressive. And being in front of this structural divestment is key for our clients. Being aligned to companies that are ahead of this inevitability, and by factoring carbon capital at risk into asset allocation, is a key element, we think, of our fiduciary responsibility. But it's not just about mitigation. It's not just about not holding oil and gas or not holding miners. It's also about adapting how we price assets in the context of climate. And that isn't just about what a company sells, it's also about how it operates. And I put in the deck an example of what this looks like from a bottom-up stock selection perspective. So it's not just something that's notional. We can quantify this risk, and if we can quantify it, we can measure it, and we can measure it, we can price it. And we can price what that means to the companies we invest in. And as active managers, we only focus on materiality and relevance of broader impacts. So an example that I would like to present to you is the cement sector. If cement were a country, it would be the third largest emitter after the US and China. Now, we need cement as a society. It was first introduced meaningfully by the Romans in 200 BC. With an interruption of the Dark Ages, it's formed a vital cornerstone of our infrastructure ever since. There's no scalable immediate disruption on the horizon that we need to consider currently. And at the moment, cement companies have carbon allowances that commit them to emit a certain amount of carbon into the air. Now, if these allowances were retracted, which, given the legislative landscape that we've just discussed, is, I would argue, a sensible risk to price. If those allowances were retracted, what would that mean in the context of future cash flow? So we're effectively internalising previously externalised costs. And we look at a series of companies who make the same thing. And we look at how that would impact their cash flow. And we see very quickly that there is a disparate spread in terms of how companies would survive that inevitable policy scenario that we've discussed. And if we apply a $10 carbon price, which is conservative, it's trading closer to 25 today, and banks are predicting it goes closer to 75 at the end of next year. If we apply a $10 carbon price, we see some companies in that sector lose half their cash flow, gone, just by having to cover that cost of the carbon that they're pumping into the air. If we actually cost in the price of where it's trading, several of those companies go bust. They're bankrupt. They've got no cash flow. Now, there's an element of caution on this scenario because obviously I would anticipate there is cost pass-through that would be considered across the sector. But even in that regard, those companies with less cost to pass through are in a more attractive position on a forward basis. So identifying, quantifying, pricing these broader risks is an important stage in understanding the future return potential of these companies. And if we then allow ourselves to take a moment to consider some of the social goals, which often get overlooked, we've seen progress this year in the context of the environmental elements of the UN Sustainable Development Goals. But the situation has deteriorated with respect to others, particularly on the social side. Global poverty progress has been set back by a decade. The pandemic has exacerbated existing inequalities, with COVID-19 fatality rates highest among the most marginalised. We also see a similar pattern within economic effect. The UN and World Bank has warned of millions of people being pushed back into extreme poverty. So the virus has undone over a decade of work to reduce these inequalities. And it's not just a developing markets issue. We see in developed markets and developed economies that the crisis has unveiled with a sharp wrench the fragility of the current global economic construct. We see the US unemployment rate between March and April. US American unemployment rate skyrocketed, worst levels since records began at the beginning of the century. The unemployment rate of adults with no educational qualification shot up from around 6% to over 21% in the space of a month. That's the minimum wage cohort who can least afford or survived prolonged unemployment. By contrast, those with higher education qualifications saw a much more muted impact from the contraction caused by lockdowns and the pandemic. And for us, these rates, the sharp acceleration in these rates really exposes elements of fragility within the foundations of the global economy. And it is very clear that we need to reset the balance. With global social inequality set to widen in the aftermath of coronavirus, we heard from our own Chancellor last week that he's anticipating UK unemployment to peak midway through next year. We've seen some worrying statistics coming out earlier today in terms of the uptick in child poverty, a stone's throw from the House of Commons. And how companies respond to this urgent social issue will be critical. And in another presentation I give, I actually go on to focus and look at the alpha correlation, so the outperformance of companies who've had a very strong corporate response to the humanitarian crisis. And we look at that correlation of total shareholder return and human capital management. But for the purpose of this evening and this conversation and the upcoming panel, I really wanted to focus on positioning sustainable investing as a core allocation within a savings spectrum. One of the things I would say, and I'm not going to spend too long on this because two of the previous speakers have already discussed it, but there are over 400 different ESG data points that we can apply. There is little standardization, by extension consistency, on how those data points are measured. And the industry relies quite heavily on unaudited self-reporting of companies. And we see what that looks like in the example that was given with also Tesla, Diageo, and who was the other? BAT. So if we think about it in that context, we've already discussed the inconsistency. the lack of correlation and conclusion, for us as active managers, that gives us an advantage. Yeah, it's really interesting. We're an industry that likes to complicate, obfuscate and complicate. If we take risk-adjusted returns, our very core reason for being as material risk takers, we can report every basis point of return that we've delivered against every unit of risk that we took to deliver it. And we can cut it any which way we like, whether it's information ratio, Sharpe ratio, Sortino, alpha, beta, delta, whatever, you name it, we can cut it several different ways to overcomplicate. And so it's quite extraordinary that the industry has raced to apply over 400 different material insights into companies and blanket apply them and assimilate them into a single score of good or bad. Very uncharacteristic. And it took decades to standardize financial reporting. So it's quite interesting to see the momentum of harmonization of these broader sustainability factors. We've seen huge momentum in the last 5 years alone, and we had the Green Horizon Summit last month in November, which I think will probably still be online if people are interested in looking at it. So you had Lagarde and Carney and Michael Bloomberg and the great and the good all presenting. But what was really interesting was the harmonisation of standards of accounting. And TCFD, so the Task Force for Climate-Related Financial Disclosure, put out recommendations on how to standardise and manage these broader factors. So we've got, and not least, it will be mandatory for companies within the UK to do this reporting by 2025. So we've got a huge acceleration, both in terms of demand, transparency, but also harmonisation of those accounting principles. And for us as active managers, we think that's an advantage, but also when we think about these 400 different metrics, we only think about them in the context of materiality and relevance. And we think about ESG as a coin with two sides. On one side, you have risk to future cash flow, which I've sort of illustrated with that cement example. And if you flip that coin, on the other side, we look for alpha correlation or clear relationship with shareholder return and individual ESG factors. For us to be so selective, we think that's a notable advantage. We've made the point that there is no correlation and therefore no conclusion in the third-party providers. And for us, when we think about this, our investment philosophy is quite simple. We like to invest in the highest quality companies that are leading the transition to a more sustainable world economy. And we define quality by those companies who balance the need of three broader stakeholders. So that is the planet on which we all depend, the people with whom we all coexist, and the profit that we all require from our savings. And the reason that we do this is that we think that these companies are the most attractive on a structural basis and therefore better positioned to deliver more attractive returns. And that's bringing in that piece that we heard from Robin in terms of planet, people, profit. Why do we do this? Because we think it will lead to better returns and enhance client outcomes. But one of the things that we get quite a bit of pushback, which is quite interesting, is on the fact that there's a lot of preconceptions around ESG. We use ESG as an investment tool. It is an input to deliver sustainability as an output. But we get a lot of preconceptions that there is a perception that you have to forfeit returns to integrate ESG and sustainability lenses. That's not our experience. In fact, we make a very important point when we discuss our investment framework that economic sustainability has to come first. And perhaps that's a session for another evening. But what was interesting to us, the byproduct of our investment framework was a portfolio that was not only completely aligned to the UN Sustainable Development Goals, but also the companies that we had analysed from a bottom-up perspective were already aligned to a 1.5 degree climate scenario. So that's 2 decades beyond what the Paris Agreement has set out to achieve. So that's a net zero alignment. That was a byproduct of our process. And I think evidencing these returns on a broader stakeholder basis will become increasingly important for clients as well, and for fund selectors like Charlie to understand how that capital is being allocated. So we actually deliver a very detailed annual impact report. And I think that will be very important going forward in terms of helping people understand how their capital is allocated. And as I mentioned, I was a little bit cheeky, a bit of a shameless fund inclusion in the deck, which looked at our performance and risk volatility characteristics, because we really do want the industry to understand that there is a compelling opportunity here to increase your alpha and reduce your beta. And that's certainly one of the achievements of the fund, that I run since we launched. The team have been able to deliver, is that we have taken on less risk than the market and been able to support a 6.5% annualized alpha relative to the MSCI All Country World Index. So meaningfully attractive portfolio characteristics on a diversified basis. And I think when we think about this in the broader spectrum of the conversation tonight, with the status quo shattered, what the world has done is demonstrated that it can mobilize on a collective basis. And if we allow ourselves to look back into history for more permanent positive change post a crisis, it's of interest that it was actually in the wake of World War II that the NHS was founded in 1948. That is an organisation that has become the embodiment of collective action. And when we come through this crisis, I think we'll see a clear opportunity and therefore acceleration for capital markets to participate more meaningfully on broader value creation. And if we apply that collective action and that opportunity for capital appreciation by investing in companies that are positioned to transition to a more regenerative form of capitalism, where companies, they do treat workers well, they don't exploit vulnerable communities, who take proactive action in a crisis, who manage their environmental impact, those companies are better positioned on a structural basis, and therefore we anticipate we will see greater correlation in asset prices reflecting that structural positioning. I think one of the few points that the last point that I would just make, there is a huge interpretation of how to deliver this on a product level across the market. We've heard that from a values perspective, but for us as well, it's also about, in terms of that diversification, that liquidity, that active element of it, but also looking at it in the context of disaggregation of risk. And it was very important when we designed and launched our own investment framework to deliver this product